Hi, I'm Jake, the General Manager here at MRE. The build-to-rent sector is a really interesting space for us to watch. If we look overseas at some capital cities, build-to-rent comprises up to 25% of available rental stock, and investment overseas has been enormous. Now here in Australia, build-to-rent represents less than 1% of stock currently. However, Victoria is really leading the way at the build, with several thousand and up to $15 billion already committed to these projects. Now these are large institutional investors, multinational firms, private equity management funds. These are not your typical mom-pop superannuation type of investor. They are seeking safe, secure returns because they know that everyone needs a place to live, they know that our population will continue to grow, and that our urban centers are going to continue to be an attractive place. What we do know, however, is that even with the rise of build-to-rent in capital cities, it comprises only a portion of the available rental stock for renters. Privately held properties actually retain and even grow in their value, in their valuation. But again, it's going to come down to amenity. The renters will be comparing what can they get in a more premium type of BTR setting versus what can they get in the private rental market. We need to make sure that we're continuing to offer clean, safe, secure, high amenity properties in desirable locations. This is a really dynamic market, so it's an imprecise science. But if the proposal for a 7.5% short stay levy does actually hit the market, it will ultimately impact investment property owners. What we know is that there are around 5,000 short stay rentals in Melbourne. And if you expand out a bit further, the inner suburbs, around 8,000. So from the 1st of January 2025, what we anticipate seeing is that 7.5% levy will be passed on to the consumers. It looks like hotels and hoteliers, however, are going to be exempt. That's going to mean that the hotels become relatively more attractive for the punter. We anticipate that that's going to be creating a situation where some owners who don't really need to have incidental access to their own property will seek the security and the safe returns of a long-term lease. Any investment property owner who's currently in the short stay market looking to go into the fixed term lease market already has themselves in a really advantageous position because their properties are furnished. What we are seeing is that furnished properties, particularly in the CBD, in Parkville and Carlton, are highly attractive to renters. They're generating anywhere between 10 to 20% higher rent than unfurnished similar properties. But we do know that quality matters. Renters want to be able to move into a home with high quality, new furnishings, appliances, and furniture, and they will pay a premium for it. It's something that our expert team at MRE advise on quite a bit. We manage almost 1,000 furnished properties within Melbourne CBD. So if this is something that you are interested in, reach out to us. Happy to help. As expected, we have seen a decrease in demand for this past quarter. However, we have seen a corresponding decrease in available listings. These two dynamics have really balanced out in a classical economic setting, meaning that prices have remained strong. Although we haven't seen the surge in rental price growth these past few months that we experienced at the start of the year, we anticipate that it's coming down the pipeline again. Looking forward, we know that the Australian government still has a backlog of almost 300,000 international arrivals who will be coming into Melbourne, Sydney, Brisbane, and capital cities. We know that we have this traditional peak period where people are going to be moving. This is when you see a lot of student transition and people moving interstate, and we're going to see that again this summer. We anticipate that rental supply will remain fairly tight for the next few months until we see a large number of leases expiring in that peak season between January and March. So we do anticipate strong rental growth coming down the pipeline again. There are always going to be legislative considerations that will impact landlords. Granted, I don't know how much further the legislation can go. In certain areas, it's already pressing the boundary pretty tight. What we have seen with the recently announced housing statement from the Victorian government is that we are going to be looking at a few more tightening of the regulations that will impact us. For example, providing 90 days instead of 60 days for any rental increase notice. We already have a 90-day notice period for notice to vacate. One fairly significant proposal included in that paper was actually a proposal where landlords would be unable to increase the rent between two fixed-term tenancies if they've given notice to vacate to that first renter. Essentially, landlords would be forced into maintaining the exact same rent for the next rental period. What that means is that we need to get it right, because landlords might be on the hook. They might be locked into the same rent for 24 months. Again, it really drives home the importance of expertise and a team that you can trust. We love hearing from our owners. If you have any questions, or if there's anything that you would like us to explore and discuss in the next quarterly update, please get in contact or fill out the survey below. All the best.